Good afternoon and welcome everyone to this post-reporting season market updates. My name is Piers, Bolger, and I'm joined here today with the rest of the Infinity Asset Management team. Today we'll be hearing from our two senior portfolio managers in Chris Adams and Dom Milchek, along with our two senior investment analysts, Ben Castley and Tom Curtis-Hardy. We also have in attendance our two senior unlisted analysts in Andrew Miles and Chris Reynolds. Today's session is going to be a Q&A session with the team. It will be recorded and participants will also have the ability to fire any questions to any of the panelists via the chat box in your screens below. We've already had a number of questions that have been sent through, so if we don't get through all the questions that have been asked today, we'll follow that up after today's recording. Despite the challenges of COVID, equity markets have enjoyed an extremely strong last 12-month period. The ASX 200 accumulation index is up over 30% over the last 12-month period, over the last 12 months to the end of August, and global equities were up a similar level of performance. However, throughout all of that, we've seen some ongoing challenges: supply chain imbalances, increasing labour costs and shortages in some areas, port closures in major hubs such as the US and China. We've seen factory closures in Asia, ongoing freight and logistic challenges, and raw materials have been at a premium as a result in regards to the ability for corporates and industries to be able to continue to deliver. So in the face of all these challenges, we thought it was actually a reasonably solid reporting period. And I think probably just to kick things off today, might start with you, Dom. What was your overall take on the reporting season just gone?
Yeah, as you mentioned, Piers, I think our view is it's pretty positive, and particularly in the large cap space, we saw more companies beat earnings expectations than those that missed. We saw pretty positive sales, and that was a strong momentum, which in our view justifies the current level of the market. And pleasingly, we did also see those stronger earnings come back into shareholders in the form of higher dividends. It was probably a little bit below what market was expecting, but that was due to a lot of the cash flow coming back in this form of buybacks and versus special dividends, etc. So yeah, overall pretty pleasing. There was some slight downgrades to FY22 expectations, but we're not too alarmed by that. That is pretty typical post a reporting season period, particularly given some of those challenges that you mentioned. But overall, we're pretty positive on the back of that.
And Chris, just in the small cap part of the market, obviously again some challenges there with what we've seen, but how did you sort of see that in relates to the SME portfolio?
Yeah, thanks, and likewise to Dom's comments. It was a pretty positive reporting season. Normally you can expect to get a few wrong in your sort of smaller mid-cap part of the world, but we're very pleased with the vast majority of our investee companies, and there were no major surprises. Most of the companies finished the year off pretty strongly. The only sort of word of caution which you alluded to revolves around sort of COVID and store closures impacting retail. There is as I've mentioned before, a big retail component within the smaller part of the market, and obviously store closures aren't helpful in that regard. And we're also seeing supply chain issues with factory closures in Asia, due to COVID concerns and raw material constraints. So there is the cautionary tale around the start to this year and the outlook given that COVID backdrop, but the market is increasingly prepared to look through that and sort of back good long-term strategies and companies and management teams where they can see the path through. And overall, we've got some modest exposures there. We don't want to have no exposures. We want to be able to benefit as this COVID recovery trade, if you like, starts to kick off. And we're well placed there. But likewise, we're not sort of fully blown exposed to that. We're still not in travel, still not in those sort of companies which are heavily reliant on things opening up, because we do recognise that it could be an uncertain recovery or reopening sort of profile, but we're well placed as things start to pick up again.
And just on that side of things, when you sort of say well placed, what are some of the exposures that we do have in the portfolio as it relates to the sort of that consumer sector?
Yeah, well, we still own Tyro, obviously a popular pick, and they have a number of their retailers still shut, in the hospitality side of things. We own oOh!media, that's back in the portfolios again, and they've got a large travel / commute exposure, which has basically been dormant for the last year or so. Cleanaway were impacted to some extent, and we do have a few retailers. The retailers we do own, City Chic, Baby Bunting, and Nick Scali, they do have a large and increasingly growing online capability, and that's what I talk about in terms of our, if you like, hedging within that space to be able to benefit as as stores start to reopen, but also have that online presence to cover, for ongoing closures, because clearly online sales, internet sales have been very strong through this period, but you'd expect that to come back a bit, as stores start to open up again.
And just on the EPS side of things, as it relates to the small to mid cap part of the market, obviously we've seen a reasonable bounce come through. Where do you sort of see that over the next sort of 6 to 12 months as it relates to this part of the market? Do you think it'll start to flatline? Do you still think there's further upside from here, just given the low base that it's come off?
Did you just say the EPS side of things?
Yeah.
The EPS side, yeah. So obviously, a strong year last year in that, more discretionary side of the market. But don't forget also that the small cap part of the market is heavily exposed to a lot of the commodity companies. So, for instance, we've got about 20% of the portfolio still in commodity type stocks. Whether it's pure plays or mining services related, or companies like BlueScope. So there is that macro backdrop as well, and it's really interesting because we've seen this sort of two-speed, if you like, commodity price profile, where you've got the sort of iron ore and non-renewable type commodities come off quite a bit over the last few months, but then your clean energy exposed commodities like copper, nickel, and lithium have continued to rise strongly. So we're very well exposed on the renewable side. We've got Independence Group still, Oz Minerals and Mineral Resources, which have a large lithium component, and so we think we're very well placed on that front. And and then there's still a large rump of the portfolio in more defensive technology, healthcare type sectors, where it doesn't really matter what happens with COVID to some extent. They'll continue to grow earnings in a more stock specific fashion. So, we obviously we've had a reasonable period in terms of EPS growth and price performance, but we're still pretty positive that the backdrop's supportive for more of that.
Just on that commodity play, Dom, obviously, BHP and Chris also mentioned Oz Mineral alike, but I mean, we certainly saw some pretty solid results out of some of the large miners. Obviously, our biggest position in that mining space or material space is BHP and Metals and Miners. How did you sort of see that result? Obviously, equally, they're always looking to divest in some of their less, ESG type friendly parts of the market. Look at copper. To increase exposure there, potash as well. How did you sort of see that result and sort of some of the plans that they're looking to do going forward?
Yeah, overall, we thought it was a positive result, clearly benefiting from much higher and much stronger for longer iron ore prices. We certainly don't expect, and we've seen iron ore, as Chris mentioned, come off quite significantly in the last couple of months. But really, we maintain our overweight position and comfortable in our overweight position with BHP due to the fact that, as you mentioned, the divesting some of the coal and looking to propose to demerge their oil and gas businesses to merge with Woodside. We think those make strategic sense in terms of, focusing on what they're calling these future-facing commodities, which we have a very positive view on in terms of copper, nickel, and potash being used in fertiliser. So we think that frees up some, if it goes through, we think it should free up capital. And so from a strategic perspective, we like the direction that BHP is moving in. And certainly, there's some concerns about the overall level of growth coming out of China and globally, and what that does to bulk commodities. We're certainly not in the camp that we think iron ore is going to remain at elevated prices, but we think, if anyone's concerned of why are we still overweight and owning BHP, we still see the positive play there. And I'm not sure if Ben can touch on any further thoughts on the strategic element around the oil and gas assets with Woodside.
Yeah, for sure, Dom. We think, strategically, it definitely does make sense as well from Woodside perspective to take on those assets. So basically, they're already in the game of oil and gas and LNG anyway. So they're not particularly getting as much of a focus on how are you being sustainable and ESG focused as names such as BHP are. Now, obviously, they are as well, getting what are your emissions targets looking like, but at the end of the day, if you're in oil and gas, you are in oil and gas. So it's hard to hide from their front. The most positive part for the Woodside perspective is they are taking on the assets and no debt, which basically frees up a fair amount of balance sheet capacity for them to try and get through this Scarborough development project. So they'll reach final investment decision on that before the end of the year. The biggest issue for that is it is a $12 billion US project to fund to build. Has a 12% IRR, really low CO2 reserves in the project, so it is considered green when you're considering oil and gas. The issue is just how do you sort of fund that? So they haven't necessarily had the balance sheet capacity. They're looking to sell down 49% interest in their Pluto Train 2. They haven't announced that yet, but they're expecting to before the end of the year. And then being able to borrow against those assets they get from BHP should free up that capital to meet that $12 billion requirement. So definitely makes sense strategically for Woodside. They're currently trading at sub 5 EV EBITDA, which is at almost historic lows. And it's not necessarily to do with the performance of the business or the price of LNG, which has rebounded to greater than the March 20 lows. It's more or less due to sentiment around some of these companies, such as oil and gas, that now are quite evidently trading at a fair discount to their more sustainable peers.
Just on the merger there, or proposed, as you say, in context of the petroleum assets, I mean, where do you sort of see? Do you think there'll be more M&A activity coming through, the market over the next little while, Benny, or do you just expect it to, as I said, be selective in the construct?
Yeah, definitely in the consolidation phase. I mean, we've also seen Santos and Oil Search actually approve that merger as well in the last week or so, which was proposed a few months ago, pre-reporting season. And again, it's just showing the benefits of scale for these businesses. So just back on the Woodside example, so when they take on those BHP oil and gas assets, that'll bring them to about $40 billion market capitalization. It'll put them in the top 10 global producers of oil and gas, and it'll make them actually 2% of the ASX 200 index. So it makes them a significant player, and there's extreme benefits to scale in that sector. So yeah, we definitely see further consolidation in that space.
And just on the pipeline side of things, obviously APA was a relatively new addition to the core portfolio. You just want to give some of your thoughts on sort of how we sort of see that side of the distribution element associated with oil and gas and the like.
Yeah, so APA, as you mentioned, was a recent addition to the portfolio. So just on the back of some of the macro commentary around some of the potential risks, we thought it'd be an opportune time to add some potentially defensive exposures. So APA owns over 50% of Australia's gas transmission network. They're also heavily invested in renewable energy. They're getting into grid connectivity as well in the electricity space, and very defensive revenue stream. They've got expansion opportunities to go over to the US and buy some of these assets, which are trading at a depressed valuation. And they are an infrastructure asset play, cash flow yield generating asset. And we've seen some of these names just sort of fly off the index recently. Everyone's seen the Sydney Airport bid, which is just even the biggest bulls on that asset couldn't necessarily get to that valuation metric which they struck. So some of these infrastructure players that are just sort of considered nationally essential are just getting bid up by some of these institutional funds. So we're not necessarily expecting or suggesting that will happen to APA, but if it does, there's a fair amount of valuation upside there, and if not, we expect sort of 8% recurring distributions on that asset going forward.
I think, to be honest, I think it also plays into sort of, one of the strategic themes that we have across our portfolios, and certainly in the way that we do our research, is around that element of sustainability. And that's obviously something that we look at for every company and or investment manager that we look to put into our portfolio. So, very much plays into that. And, Chris is talking about, obviously, some of the renewable commodities. I mean, how do you sort of see the growth of that side of sustainability? I mean, clearly it was a big focus for a lot of, and pretty much every corporate that we spoke to as it relates to their updates to the market. Do you think that that's going to become an increasingly important element of the corporate landscape going forward?
Yeah, absolutely. And I mean, everyone else can comment on that as well when it's their turn, but all the companies which I've sort of listened into and cover significant increased scrutiny on sustainable practices, hitting targets, over-hitting targets, setting goals and benchmarks, etc., particularly in the oil and gas segment. So APA, for an example, large gas transmission network. So, if your first layer of that is, how sustainable is that? That is ready-made infrastructure to deliver green hydrogen at some point in time if that becomes economically viable. They are invested in a fair amount of green hydrogen development projects alongside companies such as Fortescue, etc. So, if that investment pays off, they've got a ready-made transmission network ready to ship that around as well. And unknowingly to most, they're actually a top 10 renewable asset owner in Australia in terms of generation capacity. So, all these businesses are looking to sort of show and disclose how they are looking to move to a more sustainable practice. Santos as well, not a name we own, but just listening in, and they got a significant amount of scrutiny on that call, and they continually highlighted to the development in a carbon capture project. So basically, they're looking to build a carbon capture facility which would offset some of their own internal generation, but they're potentially hoping in time that they can sort of expand that and potentially sell some of the credits they generate from that facility onto players such as Qantas and other businesses that are getting a bit of scrutiny. So corporates are definitely focusing on it and are definitely investing in it. So it's encouraging to see.
Thanks, mate. Tommy, what was your highlights from most recent reporting season?
Probably one of the biggest surprises was Pro Medicus. It did report slightly above the consensus in terms of earnings per share, but also EBITDA margins, and as well as EBIT margins of over 60%. That was quite a surprise. If I look back maybe 18 months ago, people were thinking 52% EBIT margins was sort of the ceiling. But now, we can see that it actually has a pathway and scale to see in 5 years' time, maybe the EBIT margin could be closer to about 80%. There's been a number of contract wins, and I guess in this year it will show a really steep revenue increase. The other thing in the FY21 report was that in addition to just being a visual or radiology software, the archive part of the business, it wasn't actually supposed to be a revenue generating part of the business, but they showed the revenue was about 3 or 4 million, and that was sort of accidental revenue as existing customers started using their archive feature, which they didn't used to not charge for, but now they do.
And just on those contract wins, clearly they've been offshore, most of them, but do you just want to expand a little bit about those wins and how you sort of see that playing out for future contract wins over the next 12, 18 months going forward?
Yeah, so I think Pro Medicus has about 10 out of the top 20 US hospitals. And when I mean top 20, it's sort of by the biggest in terms of most profitability, as well as attracting the brightest medical or radiologists from Harvard and Yale University. And they sort of have maybe a 50 or 60% market share of that space. The hospital system in the US is quite complex, and we've only seen a few mainstream hospitals be on board to take on Pro Medicus's radiology software. It is a much more expensive solution, but it is a much more efficient solution. And so we're thinking only a few mainstream hospitals have sort of taken that option, the more expensive version versus the competitors. And I guess there should be a lot of, maybe 3 or 4 contract wins for this year, but most of it should be all in the US and maybe 1 in Europe.
And just on other sectors, so you cover financials on the small to mid cap side of things. How did you see that play out? Obviously, we had a position in Magellan, which we exited as relates to the SMID portfolio. What was your thoughts on that result?
Yeah, so the underlying result was actually, maybe it's just a small miss. The only thing is that I think most of the market was not comfortable with the statutory profit, which included the capital raise costs, which were about 150 million. And it's not really a cash outflow, but it has to be recorded on the balance sheet as a liability, as well as hitting the income statement later in the future. And then the other part was people didn't like the, I guess, the cost of investing in Barrenjoey. I still like that type of unlisted investment. If we look through the Barrenjoey result, they hired about 150 people in investment banking, and maybe they started in about September last year, and they recorded about 18 million of revenue, and most of that came in the last 3 months of FY21. And the company recorded, maybe a $40 million loss, but that we can see Barrenjoey's bankers are sort of very active at the moment, and so that loss should narrow for next year.
And just sorry, mate.
Yeah, go.
I was just going to say, Dom, just on the back of some of that. I mean, Barrenjoey is obviously very active in the M&A part of the world, but we obviously saw some fair bit of capital management activity come out, particularly on the large cap CBA. Woolies is an example. Some of your thoughts on that, and also probably with the banks reinstating their dividends, how do you sort of see that play out going forward more broadly across sort of that large cap part of the market?
Yeah, definitely. I mean, clearly we welcome any return of capital and ability for those companies to buy back their own shares and help improve the EPS for existing shareholders and pass on some of those franking credits to those that it might be beneficial to in the sort of the pension phase. But yeah, overall, I mean, from a bank perspective, CBA was the only Big Four bank to report FY21 results in August. We see the other Big Four report at the end of October, beginning of November. But really, it was a positive result, but we think a lot of the heavy lifting has now been done with the banks being able to unwind bad and doubtful debts. And even though CBA came out and announced that, the huge drop in the provisions that they have on their balance sheet, that we believe is pretty well priced in now. We didn't see a huge share price reaction to any of that news from CBA, and we don't expect any huge, announcement in the November results, but clearly that unwinding of provisions and return to profitability is allowing the banks to steadily increase their dividends back to pre-COVID levels. And so from that perspective, it's a mild positive, but, from a broad bank perspective, if we look at the share price reactions over the last 12 months, many of the banks are up sort of 50 to 60%, significantly outperforming the market. And so we have been using the last month or so to be, sort of taking some of those profits off, particularly CBA, which outperformed quite significantly over the last 3 months, as well as NAB. As I mentioned, we think a lot of that heavy lifting and outperformance is now priced into the current share price for the Big Four. Yeah,
and we only hold NAB and CBA in our core portfolio. You just want to talk through, clearly we're less underweight than where we were previously over the last sort of 18 months or so, but you just want to talk through some of your thinking around obviously only holding the two majors and how we're also getting other sort of diversified financials exposure into the portfolio.
Yeah, definitely. I mean, I think having a concentrated portfolio of 20 to 25 stocks means there's pretty high competition for capital within the portfolio. And, we want to make sure our best ideas are in there and we're not owning stocks for the sake of sort of neutralising a sector position, and the banks being such a big part. I don't think it's necessary to own all four really. And having a sort of quality growth bias that we do in our portfolios, we think, yes, CBA trades on a premium to the other Big Four banks, but if we look at sort of the month on month and the most recent APRA data, CBA is clearly winning above market share. They're growing above system in retail mortgages, deposits, as well as business lending. So that's a very strong positive and in our view justifies the premium. And then we also have NAB in there because we believe that provides the operating leverage to a recovery. You're certainly not going to sit here and say we know when that recovery exactly will be post-COVID or what the shape of it looks like, but we think they're well placed in that small business part. And really we don't think we need to own, in our view, the lesser quality names in Westpac and ANZ, both of which, they're going through their own sort of transformation reset years, which might be able to see a decent amount of sort of turnaround, but really we think price-wise, we prefer the quality name in CBA and that leverage in NAB. And so we offsetting that as well with owning Macquarie, which didn't report. They report out of cycle in terms of their financials, but gave a very positive trading update. And so that's where our preferred overweight lies in the financials space. We think there's a lot more, clearly diversity in a Macquarie business model, not just the banking and mortgages, but also, that pipeline for growth in terms of offshore and asset management.
And just on some of those exposures, Chris, I mean, we have, as you spoke about, we've got a good position in the materials, but equally in the IT sector. Tommy spoke about PME on that side of things as it relates to the SPID, but that's certainly one of our bigger sectoral exposures. Just want to sort of give an update on how you sort of see that, because certainly people take the view that the sector's run pretty hard, and if we start to see bond yields move higher over the cycle, that will be negative for the sector. What's your take on that, mate?
Yeah, well, we're about 15% of the SMID is in what you'd call IT tech sort of stocks, and we own Xero, and as you said, Pro Medicus, Megaport is one of the more cutting edge plays we've got. Look, we're not too fussed about the benchmark weight, but the benchmark weight is around about 15%, and that does reflect that macro uncertainty, that backdrop there of rising bond yields. Now, arguably, that sell-off occurred pretty strongly at the start of this year, and we saw the tech stock, generally speaking, derated. And increasingly over the last sort of 3 to 6 months, it's certainly been the experience with the stocks we own. If you've had the strong sort of stock-specific attributes, good company fundamentals, these companies have been able to perform strongly. And we saw that with Pro Medicus, which has been one of our best performers this year, despite an unhelpful macro backdrop for high tech plays. And so, look, I guess, and this is consistent with the way the portfolio is constructed generally. We don't want to be taking a huge sort of sector or macro bet given that uncertain backdrop. But by the same token, as we've always suggested, this is an exciting part of the market, the exciting part of the sort of universe. There's some of these companies which can grow very strongly, have disruptive and cutting edge technologies. We certainly want to own some of the more exciting ones, but not be too overly exposed, generally speaking. So what we did see with companies like Appen, which thankfully we've been out of for some time now, where they've, you don't have to miss by much to get heavily sold off given some of these aggressive multiples. So you've got to be very careful what you own, but if you get the right names, you can still get some very good performance out of that part of the market. But clearly, just by way of background, this is sort of the highest duration part of the small cap market, and if bond yields go up aggressively, which is probably the broad consensual suggestion, that's going to be a bit of a headwind for the sector.
And on the other side, I mean, we've obviously got some good exposure to, again, sort of the thematic around sustainability on the ag side of things through Elders, as well as obviously Select Harvest, and clearly Select Harvest has benefited from some of the agricultural challenges, wildfires, as well as obviously drought in the US. But do you want to sort of, again, talk through the thematics that we're seeing in that part of the market as well?
I'm glad you asked about ag, because I think it's one of the most exciting parts of the small cap part of the market, and they're the two stocks we do own. And look, just starting on Elders, that's a pretty simple story. They're exposed to both soft commodity prices and volumes, and we're seeing boom conditions across the board there. One of the big drivers for Elders is cattle prices. Now, the consensus was that cattle prices would come off this year, but the reverse has happened. They've held firm and they managed to increase. So that's been supportive for that. And seasonal conditions across the country, which is, it's rare that you get positive seasonal conditions on both sides of the country, but that's very much the case now. You're seeing record rains in WA and good, strong rains here, and it's a pretty good backdrop for Elders. Select Harvest has been a really interesting story because we've owned that for some time now, and up until about 6 months ago, almond prices have dropped to all-time lows, arguably unsustainable lows for a lot of farmers at about $6 Australian a kilogram, and even Select Harvest themselves were pretty much break even around that sort of almond price. So it was starting to sort of test our patience, but this is once again having the right balance, and that Select Harvest firmly fell into, like you might say, a value type of stock because PE was quite low, and we sort of thought, well, if they can get any sort of rebound on the almond price, this thing's going to take off because as we know, equity markets move well ahead of commodity prices. And in fact, around about June, July, we saw the first update from the company suggesting there'd been a stabilisation in almond pricing, and in fact, it had started to turn. Now, the demand profile for almond pricing had always been solid, and that's primarily India and China. There'd been some disruptions in China, not thankfully, not like we saw in other commodities, but that was just more, COVID issues and so forth. But what we did start to see, and the 80% of the world's crop comes from California in the United States, and it's very, very dependent on the ice pack and the rainfalls that allow reservoirs to fill over there. And California now is apparently going into an extreme drought. Now, these droughts have happened before. They're not uncommon, so that's not like one of these once in 500-year experiences that you talk about. So basically, that's why the almond price is now rebounding aggressively, and the almond price itself is up about 25% from those June lows, and we're talking all-time lows. And select harvest itself is up about 50%. So that's a position that has worked very well for us. And we do like soft commodities. They're not always easy to find, good exposures to, but that's one where you can get a quality exposure to a healthy protein, which we have good growing conditions for here.
Yeah, it's been terrific. And just on another sort of part of the market that's gone gangbusters has been the property side of things. I might start with you on this one, Dom. Obviously, James Hardie out of the US had a cracking result, and clearly pointed to some really ongoing strength. How did you see that result, and where do you sort of see the longer term upside for Hardie's?
Yeah, definitely a really strong result. And on the back of that result, we had a high level of conviction heading into the result. It was their first quarter of FY22 result, having delivered their FY21 result earlier in the year. We had a high level of conviction heading in, and we actually topped up our position post the result because, they're seeing strong demand in US housing, particularly, as well as around the world. Economic estimates suggest there's going to be an ongoing housing shortage. So we're seeing very strong numbers in the US, not only of new builds and new building permits, but also that restoration and renovation market where, people are at home, deciding to spend some money on their own house because they can't travel, etc. And so what that's actually allowed James Hardie to do is they've pivoted a bit of their marketing. Traditionally, they go directly through to the major home builders. Now they're actually targeting direct to market consumers. And that's, allowing them to roll out a number of adjacent products to their traditional fibre cement, gypsum boards. And those are higher margin products. So James Hardie is typically, targeted 20 to 25% EBIT margin range in the US. And now they're getting closer to 30, 35%. And, a lot of the market's still factoring in that sort of 25% EBIT margin. But if they can continue to grow their sales in adjacent products, which we think they can, and they've shown, really good manufacturing skill set to do that, if you start factoring in a, higher margin from here with even only an incremental sales, we can get, stocks up over 100% in the last 12 months. We can still see further valuation upside from here on the back of that strong housing market cycle that we're currently in.
Yeah. And Benny, on the flip side, company Lend-Lease, obviously we've trimmed a little bit of that exposure in the core, and probably felt that it wasn't sort of a result that you were looking for, and it's very much in probably consolidation phase over the next couple of years. Do you want to just expand on that a little bit?
Yeah, for sure. So we've had a longer term structural view on having exposure to listed real estate companies that have not only ownership interests, but also potentially development pipeline and an asset management business particularly. And that's worked for us with names such as Goodman Group and Charter Hall in the SMID portfolio and Goodman in the core. Lend-Lease have a very similar business exposure to that. They do also have a construction business, which is unique to them. That's fine. But, they do have a development pipeline of over $100 billion globally. They've got an asset management business, and they own equity interests in each of their development projects. And in terms of valuation, they currently trade at about 33% of the valuation metric of a Goodman Group. So you've got very similar exposures. The development pipeline is really strong. They've got the contract to develop the housing estate for Google in San Francisco and things like that. So they have some really strong development pipeline assets. Where they've fallen short is just on their expectations and on their targets. So The market doesn't necessarily reward companies that can't deliver on their targets, which is more than fair enough. And it's basically, they're not getting really attributed any credit for any of these potential, their pipeline of opportunity, which, today is probably fair enough. One of the major catalysts we've seen is the exit of long-term CEO Steve McCann. He's gone to Crown. And we've got a new CEO and a new leadership team. So basically, we were considering whether it was worth exiting this business. Lendlease held a strategy day end of last month to go over, we've got a new leadership team in, we've got a new strategy. This is how we plan to map out to our 2024 targets. And we came away pretty positive on that. They're a lot more transparent on how they're going to achieve these targets. They've got a new leadership team in, and we think they deserve the benefit of the doubt to try and get to their targets, because if they can deliver, there's significant valuation upside there for them.
Yeah, terrific. And Tommy, just on, you spoke about Magellan, but we introduced obviously a new position across the SMID in Pendle Group. Just some of your thoughts on, again, what was the thesis that drove your thoughts to why it was be a positive addition to the portfolio?
Yeah, so just with Pendle, I guess in the last 3 or 4 years, it was sort of in a consistent downgrade pattern. But in the last, let's call it the last 6 to 12 months, was when that started to turn, and they sort of reduced the amount of outflows from that business. And they've actually created quite a number of attractive strategies in the US and in Europe, and they've also made an acquisition. It is, I guess, when we think about the two types of fund managers, Magellan's sort of stayed a little bit more defensive, and as we are kind of sort of in this bull market, they haven't actually delivered in terms of performance by staying a little bit too conservative, whereas Pendle sort of benefits from the uplift in a bull market. And so that's sort of how we see things. It's also very competitive in that small to mid cap space, where there's about 5 or 6 different fund managers. However, in the top 50, we still hold Magellan in the large cap portfolio due to, I guess, less competition in that space.
And just on the COVID stocks, John, probably one on transport or infrastructure, TCL and Wesfarmers. So they're probably divergent paths clearly on the back of COVID. So how do you sort of see the outlook for both of those, and the positioning? Some of your thoughts on positioning as the economy potentially reopens, and therefore we'll obviously get more traffic volumes going through.
Yeah, definitely. Transurban and Wesfarmers, two really solid businesses that we think we want to continue to own long term. We did take a fair bit of money off the table with Transurban probably this time last year, when they clearly have a high level of sensitivity to ongoing lockdowns in Melbourne and in Sydney. And then more recently on Wesfarmers, we took some of our profits more from a valuation perspective once it got over $60, and a little bit more recently, and we've seen the share price come back quite a lot since its results on the valuation, and also that view that, from Bunnings particularly, you've got nearly 40% of the store network just operating in online only. Both businesses, though, we think will be beneficiaries coming out of COVID, with traffic volumes expected to pick up significantly for Transurban, and we do like the long duration infrastructure assets. And for Wesfarmers, even though we've seen an impact to first half 22 with slower sales growth in Bunnings, Kmart and Officeworks, again, it's a high quality business, market leading positions across most of those industries that it looks at, with a huge cash balance to continue to look for accretive acquisitions. So even though we've reduced our exposure over the last 6 to 12 months to both of those names, we're still a really stable part of our core portfolio, and certainly as the outlook of recovery starts to become more clear, we could certainly see a pathway to adding more to those positions.
And just another one that I thought was really interesting through reporting season was ResMed. As probably everyone knows, obviously sleep apnea, and it's been in demand in terms of their oxygen masks, particularly overseas. But I'd love you to share the hookup that we had with the company on their announcements and just some of the challenges they're facing on the logistics and supply chain front. I thought that was a really interesting comment coming from management.
Yeah, it's probably not one that you think of when you think of supply chain shortages and particularly chip manufacturing. You hear it a lot in the auto space. But speaking to Mick Farrell, the CEO, he shared that he's traditionally in the last 10, 20 years at ResMed focused on how to get big sales through in terms of, the hospitals buying ventilators, particularly during COVID, how do governments fund ongoing healthcare needs, etc. And he said basically it's completely flipped for him. Most of the day he spends now on the phone and to chip manufacturers trying to get as many chips as he can, because all of the healthcare devices are now, internet connected, data gathering, etc. And so he's there pretty much negotiating, trying to say, well, don't give those chips to Toyota or Tesla. They should come to ResMed. And so he said that's been an interesting sort of change and learning curve from him as a CEO to be spending a lot of his time on procurement. But it was interesting just in terms of the mindset of, how some of these companies are trying to get locked in. And he said, thankfully, a lot of the chip manufacturers do like the healthcare industry more so probably than an auto manufacturer, given the defensive nature of their earnings and their revenue streams for 5 years versus a more cyclical element around discretionary iPhones, tablets, and cars, etc. But it just highlighted to us the broad reach of the impact of some of these supply chain disruptions.
And as he said, they're literally saving lives. So you can put off your new Tesla for a little longer on the back of that. We're nearly bang on time. So to yourselves, Chris and Dom, just some of the thoughts on, the portfolios more broadly. Obviously, performance has been sound. If you want to sort of touch on that, and equally just, how you sort of think potentially the next period will play out as we head into the back end of the year, and hopefully a more, reopening of domestic economy.
Yeah, happy to go there. And look, I think what's really exciting from a SMIT perspective, that normally when reporting season always throws up a few new ideas and, invalidates or confirms a few theses. But happily, when we look at the portfolio, we're extremely pleased with all the positions. And normally there's one or two you might be sort of rethinking about, or, becoming a bit marginal for whatever reason. And that's just not the case at the moment. We are contemplating a few new names, but they'll have to be pretty compelling ideas to go in, given that backdrop, and that's often not the case. So, look, obviously, last year was a bit of a funny year and quite a volatile year, and hopefully we're starting to move out of this, move out through this COVID environment. There's going to be ups and downs and further volatility this year, but generally those themes that were established over the last year or so should continue to play out, particularly on the commodity side. So we remain very positive about that. There's a retail, whether it's online or offline, and and whether the stores open up sooner rather than later, will still be, just domestic consumption should still be pretty helpful for those sort of areas. And we continue to look at a number of potential technology plays, because that's a thematic that's not going away in a hurry. So generally speaking, a pretty positive outlook for the SMIT. And we've seen that in continued positive numbers over the last few months since we finished last year.
Yeah. Dom, your thoughts?
Yeah, likewise for the core portfolio. Really pleased with the the more recent numbers, calendar year to date, outperforming quite strongly, and that plays into the longer term outperformance that's been delivered as well. But as Chris highlighted as well, we think reporting season really validated a lot of our conviction in our stocks. And even though this time last year we were seeing a bit of whipsawing between different styles coming to the fore across markets, and people talking about this big value rotation versus growth, really we think the recent round of results has highlighted the benefit of owning quality names with quality growth stories, and so we think it's going to be much more company specific driven going forward. And, again, owning those quality businesses, we believe will allow the portfolio to weather any storms of these sort of near-term uncertainties, but then have conviction and confidence in all those names across the portfolio being able to deliver close to double-digit returns over the longer term. So, very positive from a portfolio perspective. And, bar a couple of things that we're keeping a close watch on, like Lendlease that Ben noted, we do see a pathway to recovery for a couple of those names that had potentially slightly, weaker than expected results.
I should add also that, from an asset allocation point of view, we're very constructive on the outlook more broadly for growth assets, equities, both domestic and global, certainly relative to what we're seeing in the fixed income space, as Chris alluded to earlier. If we think yields have bottomed and they only head north from here, then that's going to provide a pretty challenging environment in our view for some of the more defensive parts of the market. We've gone a little over time, but I'd personally just like to thank all the team for what has been a really fantastic 12 months, and obviously been a very busy period for us. And your insights today, obviously, hopefully everyone on the call was able to learn a little bit more about the thinking behind the portfolios. As always, if you have any queries or concerns, feel free to reach out not only to your advisor if you're a client of the business, or if your advisor clearly directly to any member of the team. We'd love to hear from you, and obviously love to provide you with further and more granular insights on our portfolios and our process. With that, I'll sign off. Have a great rest of the day, and we'll touch base again soon. Thanks, everyone. Bye for now.